What is happening, people? It is your boy Jack, your favorite 22-year-old who speaks about stocks on the internet. And if you're watching this video, you, a lot like me, probably enjoy making money. I love making money. And on YouTube, up until this point, I've not yet made a single cent. I've made 0 cents on YouTube. Because there's certain things you have to hit. You have to get over 1,000 subscribers and you have to have over 4,000 watch hours combined in the last year. I put about 3 to 5 hours into my YouTube videos and I've uploaded every single day for the last 22 days. That is a lot of work for €0, but I don't see it as work. I absolutely love making these videos. I love the interaction with you guys. I love doing this. But as of tomorrow, I will have officially hit 4,000 hours watch time. And I'm really finding it hard to put into words how thankful I am to every single one of you who is now following along on this journey and supporting me. If you're not a part of the family yet, please do go ahead and hit that subscribe button, turn the bell on. We're not slowing down, guys. We're going to keep pumping out these videos every single day. We're going to keep building this community. It's going to be an awesome road ahead for us. And when I get to 28 days of daily upload, so 4 weeks of a video every single day, I might make a video just showing how that grew the channel and how it's changed the channel. So if you're interested in that, all I'm going to ask of you, please, is drop the video a like. That supports me. It's completely free, and then in return I will make that video for you guys. I'm genuinely just so thankful to every single one of you guys supporting, whether you're watching the videos, subscribe, liking them, dropping me comments. It all means so much to me, so genuinely thank you so much. But as we like to do on this channel, let's get past that and let's get into the juicy stuff, because we've a lot to cover today. So we have 10 stocks, yes, 10 stocks to go through today. That is a lot of stocks, and these are all stocks that I'm going to be watching really closely this week and potentially either increase my positions in them or getting into them for the very first time. Now, since we're covering so many stocks, I'm not going to be doing a full analysis on each one because that would be like a 2-hour video. We're just going to cover them briefly. So if you're interested in any of these companies, always make sure to go ahead and do your own research, do much more research than what you're going to see in this video alone. And always remember, me and most guys on YouTube, we're not financial advisors. What I say today is just my thoughts and opinions. Always do your own research and be diligent with your money. But anyway, baby, stock number 1. So guys, the first stock I just want to get this over and done with is Carnival, a stock that I'm not invested in just yet, and I've spoken about more in depth than any other company on the channel lately. And since I've spoken about it so much, I don't want to go into too much detail. I don't want to repeat myself over and over again, but basically they are the biggest cruise line stock in the whole wide world. The cruise line industry as a whole has been hit tremendously hard as of late, with stocks down more than 80% in the last 3 months. It's a horrible place to be, but as investors we have to decide, is there growth potential because of this big hit? This is by no means a safe stock. The chances of bankruptcy are probably somewhere between 10 to 25%, but the growth potential is disgustingly high. This is the stock I will be monitoring closer than any other this week and hoping to finally open a position in. Right now, just before market opens, it's at about $8.50. It was above $50 at its peak not even 3 months ago. It's crazy cheap, but as I said before, high risk, this could go bankrupt. Now in today's video, I'm going to be speaking about every company's dividend that we speak about today, and Carnival cancelled their dividend. That shows how tough times are. We can see last time we went through economic trouble, Carnival cancelled their dividend. They started growing it really aggressively, and now again, it doesn't show up yet, but they cut it. They are paying no dividends for the foreseeable future. So as of this moment in time, this is entirely a growth stock with massive potential. But I do believe if they come out on top and if they don't have to enter bankruptcy, this is a company that will pay dividends in the next couple of years, maybe 1 to 3 years, and they will grow that dividend extremely aggressively, and who knows, maybe get it back to where it once was. But let's just look at their stock chart. 17th of January, they were trading above $50 a share. Not too long ago, they reached $9.30. I believe it dipped into the 8s. We shot back up nearly 100% all the way up towards $18. And now we're at $8.49. We were all the way down just below $8. For me personally, I'm just going to be monitoring them, hoping that they go down a little bit lower, maybe drop another 10-20%, and then I will happily open up my first position in the company and dollar cost average. Who knows? Risk to reward is crazy here, but you really do have to be strict with your risk management. This is a very tempting company to just go bust a load of money into, but they could go bust. And next up we have Delta Airlines, another company I don't want to go too in depth on because I've spoken about them a lot in the past, but since those videos some more news has come out. I am currently invested in Delta, and if I'm to invest in any airline, it is going to be more shares in Delta, and I do plan on buying more shares. And just looking at their dividend, they cancelled it yet again. They had to cancel it because of the times we're going through now. but once they grow it, once they get back on their feet, they're going to grow quickly. Here's something nobody foreseen happening, which is why I'll be watching them particularly closely, especially today. As of this video, Monday, market open, I want to see how heavily Delta gets hit. Billionaire investor Warren Buffett's Berkshire Hathaway sold $314 million worth of shares of Delta. From what I can tell, he just wanted his stake in the company to be below 10%. That's why he didn't sell all of his stocks and why he still has an absolutely massive position in Delta. But just like the cruise industry, the airline industry as a whole has been hit massively due to the virus that's going around right now. And that is why these stocks are falling in price so drastically as well. Some good news lately was that they will be receiving some sort of bailout from the US, from the government, which gives them a higher chance of survivability, and that's what we want. We don't want these companies going bankrupt or else we lose all of our investment. And on that point, most of my stocks today are much safer than these first two. I just wanted to get these out of the way because they're kind of outliers as such. I don't personally see Delta going bankrupt. I don't see where that's going to happen. They're just so massive. But who knows, anything can happen in this game. And now we're having a look at Delta stock, and we can actually see their pre-market is currently down 5.47%, largely down to the news about Warren Buffett over the weekend. That will influence a lot of people to sell their shares. But anyway, we can see that they were up around the $60 mark only a couple of months ago. They fell as low as just over $20, and they're currently pretty much around there. They will more than likely open around the $20 mark today, which I think is very cheap, and I probably will buy some shares today. Who knows, I might make a video at the end of the week showing what shares I bought. We'll see. But now, let's get on to some of the more normal stocks, not these really high risk stocks, not these ones that are really exciting because of growth potential, just some more of the relatively safe players, and a few more risky ones probably. Next up, boom, we have PepsiCo, the first company who is actually still paying a dividend, and who actually paid me my first ever dividend only a few days ago. So, we all know who Pepsi are. They obviously make Pepsi, the beverage. They make loads of other beverages. They make snacks. They are absolutely massive. They have a current dividend safety of 93 and a current dividend yield of 3.07%. So an amazing dividend safety and a relatively nice dividend yield. And one more absolutely fantastic thing about this company is they have an uninterrupted dividend streak of 47 plus years. So unlike the last two who had to cut their dividends when times got tough, Pepsi are going to be fine. They're going to get through this. Again, I've actually done a full video on Pepsi versus Coke stock if you want to check that out, but they're going to do fine. They've paid dividends for a long time. They have enough cash on hand to survive from tough times. They are still making money. People are still buying their drinks and snacks. Pepsi are in a much better position than an awful lot of companies right now. And I just think that any company who has paid and grown their dividend for nearly 50 years and has such an attractive dividend yield, 3+%, and such a nice dividend safety score, that's been so well established that literally a child could understand their business model. That to me always seems like a good investment. You will see that Pepsi is much more than just the drink that is Pepsi. They have $22 billion brands, the large majority of which I'm sure you are aware of, and they're not all drinks. Doritos, Ruffles, Walkers, they sell snacks as well, which sets them apart from their main competitor Coca-Cola, which is why I do really like Pepsi. But just like a lot of people, they've been hit extremely hard as well. So not too long ago, they were around the $145 mark, okay? They bottomed out just over $100, and right now we're sitting pretty much at $125. So they haven't been hit nearly as hard as the large majority of companies have. They're a relatively safe bet. They're what a lot of people would call a recession-proof stock. They're a relatively safe bet. People are still going to buy their products regardless of how much money they have. You know, if times get tough, people don't care too much for the €1 or €2 or dollars that they're going to spend on a drink or a snack. You know what I mean? They're going to be worried about the way more serious things. And that's why these companies will be okay, and they probably won't have absolutely horrible earnings, at least when compared to certain other industries like airlines and cruises. I do own a position in Pepsi, and the reason I'm watching them this week is because I want a bigger position in Pepsi. I just think they're amazing. I think they're one of the best investments that I own personally, and I just want to increase that. So I'm not necessarily looking for it to hit a certain price range. I just want to keep my eyes on them. Now, while we're looking at consumer discretionary stocks, let's go through the only restaurant I'm currently involved in, and that is McDonald's, the biggest chain in the whole wide world, with a dividend safety of 77, so quite safe, a nice dividend yield of 3.12%, and they have an uninterrupted dividend streak of 45 plus years. So right off the bat, very similar statistics to Pepsi in regards to their dividend. Something that's quite nice to see and very reassuring for dividend investors like myself. McDonald's said dividend remains a paramount priority, and this was released just about 2 weeks ago. And again, similarly to Pepsi, you don't have to be a genius to understand McDonald's and their business model, you know what I mean? Everybody in the world knows who they are. Everybody in the world has probably eaten at them. If you go on holidays, you recognize them. No matter where you go in the world, you're going to find a McDonald's. That's how massive they are. I love looking at their max stock because just look at the growth. Just look at the growth. It's crazy, right? Again, let's see how hard they've been hit. They were trading close to $220 a share. They dropped all the way down to $137 a share, and now they're sitting at about $160 a share. I personally got into McDonald's, I believe it was just around the $150 mark, so we're ever so slightly up. We're ever so slightly up, baby. As I've said in loads of my previous videos, I like investing in companies who are at the top of their niche, and McDonald's is that in regards to fast food. Everybody in the world knows who they are. They are the leaders, they are the biggest, they make the most money, so that's why I like McDonald's. And again, similarly to Pepsi, I already own a position in them. I'm not really looking for a particular price, I just want to keep an eye on them because I want to get a bigger position in them. Now, number 5, a staple in pretty much any long-term dividend investor's portfolio. Johnson & Johnson, they're in the pharmaceutical industry. They have a dividend safety score of 99, which is the highest that you can possibly get on Simply Safe dividends. Obviously, they won't give 100 because there's always a chance a dividend could be cut. They have a dividend yield of 2.83%, which for a company like this is amazing. And they have an uninterrupted dividend streak of 57 plus years. So this to me is just one of those companies that I think I'm going to want to buy forever. I'm going to want to buy and hold this company literally forever. So they're always on my watch list. They're always there just waiting for me to buy a little bit more of them. And if you don't know who they are or what they do, here are the company's operating segments. So pharmaceuticals, medical devices, and consumer products. And here's just a few of the products they sell, a lot of which I'm sure you will recognize. Nicorette, Listerine, Sudafed, Calpol, Benylin, Aveeno, Benadryl, Johnson's, a lot of things that you recognize. So even if you don't necessarily know who the company is, you know some of their products and you probably have some of their products in your house. But the products that you have in your house only account for 17% of their sales. Their pharmaceuticals is really where it's at. They have dozens of patented drugs and vaccines to treat oncology, cardiovascular diseases, immunological, neurological, loads of big words that we don't really need to understand. We just need to know that they make products for these particular things and they are the leaders. And this is a company that's not going anywhere anytime soon. They sell things that people need. Regardless of how much money people have, these are things they need to buy. They can't live without them. Maybe not some of their consumer products, but the large majority of them, and then obviously the pharmaceuticals, things along those lines, are necessities. And just having a quick look at J&J's stock, they were up around $153. They bottomed out close to 111, and they're currently sitting about 134. But it's another company whose max chart you just love to look at because it's just growth. There's just growth absolutely everywhere you look. Slow, consistent growth. Not only are you getting that dividend, you're getting consistent growth. It's awesome. That's exactly what we look for in our investments. Now, next up, a company called 3M. Ticker symbol MMM. Very imaginative. They have a dividend safety of 75, a very nice dividend yield of 4.39%, and an uninterrupted dividend streak of 61 plus years. For us dividend investors, this is a very rare sight to see. It is beautiful. Now, there is a lot to 3M and what they do, but this sums it up quite nicely. 3M is a highly diversified company with 5 main business segments that cover over 45 technology platforms, ranging from adhesives and abrasives to ceramics and nanotechnology. So they're in healthcare, safety and graphics, industrial, electronics and energy, and consumer. They have their foot in a lot of different segments. They are very well diversified as one standalone company. Here's just all of the different kinds of things they sell. Tape, sealants, abrasives, infection prevention supplies, drug delivery systems, personal protection, traffic safety products, insulation, splicing, renewable energy components, post-it notes, tape, sponges, a lot of different products essentially. They're very well diversified. And again, that 4.39% dividend yield is excellent. With me personally, if ever I can get a company that I believe in that has great fundamentals, that has paid a dividend for this long, and that dividend is over a 4% yield, that's absolutely amazing to me. Over 4% is what you want. And let's just have a look at their 6-month stock, because this is a company that has been hit quite hard. Okay, we can see they peaked out around $180 back in early January, mid-January. We bottomed out at about $117, so massive. We haven't recovered all that quickly, but we're currently sitting at about $133. And just to show you that not every chart looks as nice as the one we just looked at, look, we see steady growth, we see bad periods, we see steady growth, a bad period, we've seen some incredible growth, and now we're actually in a relatively bad period, not just because of the virus, but for a couple of years. So, you know what I mean? It's not nothing but growth, but the large majority of history has been nothing but growth. So maybe history will repeat itself. You know what I mean? When this starts ticking up, we'll see a nice correction and we'll see a nice jump. Now, another absolutely massive company that you may not know right off the bat, but you probably know some of their products. You ever go to the shop, the shoe shop, and you see those big brown boots that say cat on them? That is from this company. Now, that is not the main thing that they do whatsoever, but it is from this company. Okay, so dividend safety of 93, so again, beautiful. Dividend yield of 3.59%, so we're getting very close to that 4%. And boom, where's it gone? A dividend growth streak of 27 plus years. Anything over 25 years is amazing. Anything over 50 years is just unbelievable. But this is still a very, very nice uninterrupted dividend streak, and it implies that even during these tough times, they'll more than likely be able to keep paying their dividend. Now, why am I looking at this company right now? Okay, the company primarily sells construction and mining equipment, diesel and natural gas engines, industrial gas turbines, and diesel electric locomotives. With everything that's going on with the oil industry right now, this may seem like a weird stock to be wanting to buy, to be get into right now. As well, with the fact that people are going to have less money, they may be building less houses, things along those lines, this may seem a little bit weird to a lot of you. We can see energy and transportation, that's 38% of their profit. That serves their oil and gas, power generation, industrial and transportation markets, all of which have been hit. And then the construction industries is another 38%, and that's tied to infrastructure spending. So these things that are going to be hit very heavily right now makes up about 75% of the company's profit. Just having a look at their chart, we can see that back early January they were around $145, nearing $150 a share. They dropped as low as just above $90 a share, and they're currently sitting around $114 a share. In the long term, this company is not going to disappear. People are still going to need all of the services that it provides. Does it have room to go lower? Most certainly, just like every single company does right now. They have a forward PE ratio of 14.9, which is below its 5-year average of 18.4. That means the stock is relatively cheap in comparison to how it's been, how it's been valued in the past 5 years. And it's important to keep that in mind, that if you're a long-term investor who plans on holding his stocks for 20, 30, 40, 50 plus years, the next year is a very, very small percentage of that time frame. You know what I mean? If you believe that a company is going to do amazingly over the next 50 years, a bad year or two isn't the end of the world. If you can get in at a good price, that's the most important thing. That's why I'm going to keep a close eye on this week. I do expect them to be quite volatile. Now, who knows, I could be completely wrong. We'll just have to wait and see. Boom, we are having a look at Realty Income Corporation. Now, these are a retail REIT. Okay, we'll get to that in a little bit, but they're a little bit different than your regular stock. They have a dividend safety of 86 and a dividend yield of 6.41%, which is amazing. That's beautiful. That's massive. And they have an uninterrupted dividend streak of 25 plus years. And remember I said earlier that that is a fantastic number for a company to have. But before we go any further, just in case you don't know what an REIT is, it's a real estate investment trust. So what this is, we can see it was founded all the way back in 1969 as one of the first REITs. They started with a single investment in a Taco Bell, and now own more than 6,400 properties across America that are leased to about 300 commercial tenants in 50 different industries. These are some of the tenants they have: Walgreens, 7-Eleven, FedEx, Walmart, Circle K. Absolutely massive companies. And why I like this company more than other REITs, they focus on leasing to tenants that have a service, non-discretionary and or low price point element to their business. They lease to these companies who are at the top of the game. Earlier on I said I like investing in companies who are at the top of their game, the top of their sector. They're doing that for me, and with a dividend yield of 6.41%, that ain't nothing to complain about. Now we can see that they've been hit relatively hard as well. They were up around the $80 mark, dropped as low as the kind of $42 mark, and that's currently where we're sitting. We're at about $43, so we're nearly at the bottom of where they have been this whole time. So there's been no rebound made yet. There was obviously the initial one that pretty much every stock saw, but then this next sell-off came and we're back to those lows. And the last time we saw these prices was back towards, the last quarter of 2015. So it was a considerable amount of time ago. Again, looking at their max chart, to me, it's just really nice, slow, steady, consistent growth. I think we're getting an opportunity to get in very cheap. And again, a 6.41% dividend yield. Getting that on a company that is this well evaluated is amazing. Now, I said that the risky stocks are out of the way. That was not completely true. And keep in mind, these are just stocks that I'm watching, not necessarily stocks that I'm buying. I need to keep that very much at the forefront of your mind. So MGM Resorts International, they're in casinos and gaming. I have not honestly looked into this company all that much. And that's why I'm just putting them on my watch list, and I'm going to start doing a little bit of research this week just to see. Because they have a lot of hype on YouTube. But often just because a company has hype on YouTube does not mean it's a good company. We can see that straight off the bat. A dividend safety of 24, a dividend yield of 5.67%, and a dividend growth streak, oh yeah, 2 years, baby, absolutely massive. So right off the bat, it looks like a terrible company. So why am I even going to bother looking at it? Well, first off, let's understand just how cyclical the kind of casino industry is, right? I'm going to bring you back to the max chart, and this is going to look mental. There was a stage where this company was actually all the way up at about $80 a share. And then what happened? The recession. And then what happened? It dropped to about $2 a share. Can you imagine being an investor in the company at $80 and that dropping to $2 a share? That must hurt. Once we got back down there and the economy started to grow, they started to grow as well. People have more money, they go to the casinos, they spend more money, the casinos do well, blah blah blah. But now again, we're in a tough economic time, and we can see the last 6 months we went from $33 down to about $7 at the bottom, currently sitting at about $10.50. And don't get me wrong straight off the bat here, I don't necessarily think this is even a good stock to buy. I just wanted to include it because it is something I personally am going to be watching very closely next week. MGM kind of goes hand in hand with Wynn Resorts, so I might look into them ever so slightly as well. But yeah, I just want to make it very clear that I am nowhere near deciding to actually buy this company, but there could be some insane potential there. We'll have to wait and see. Yeah, I just want to make it very clear again, I'm nowhere near actually buying this company. I just believe that there could be some potential insane growth potential. You know what I mean? I don't know if there is or not yet. I haven't done my research. Don't go buy this company randomly. If there's any company you don't buy today, make it be this one. And then we're going to finish it off with the last stock for today. Is going to be Walt Disney, a company I did recently open a position in. They have a dividend safety score of 60, which is borderline safe. It's right on the low end of borderline safe. A dividend yield of 1.87%. And they've been paying an uninterrupted dividend for 27 plus years. We can see it hasn't grown for 27 plus years, but they have paid it for 27 plus years. So that is still a very nice first sign to see. Obviously, the dividend yield is a little bit lower than we like it to be. But again, Disney is one of those companies who is at the tip top of their game, and they also have their foot in a few different industries. When we all think of Disney, the first thing we probably think of is, you know, cartoons or old cartoons, Mickey Mouse, the things like that. They also obviously have their Disney parks, which do absolutely massive revenue. They've recently launched Disney Plus. You know, they're trying to rival Netflix and things along those lines. They also have their own cruise lines, so be it, it's not very big just yet, but they have it. They have their foot in a few different markets, but ultimately they're just massive. The biggest in regards to movies and entertainment. Again, just looking at Disney's max stock chart, imagine getting in here when it was less than $1 a share. It has been nice and steady, yet quick, and then it was steady. There's been some dips, some consolidation, massive growth, and then boom, unprecedented dip, which is what we're seeing around the market. So all around the place, it's not Disney's fault. They were up around 140 a share, down as low as 85 a share, and we're currently sitting at about 93.88 a share. I've said it a few times this video already, I just love investing in companies who are at the tip top of their game, and Disney is one of them. Why I am watching them and not necessarily buying with immediate effect is because they may be ever so slightly overvalued. Now that could be completely wrong, we can never know these things. You might say, how are they overvalued after losing this much money? It's not as simple as just looking at their stock price. So we can just have a quick look. Disney's forward PE ratio is 20.1. It's above its 5-year average of 17.1, indicating that the stock looks somewhat expensive compared to how the market has valued it in recent years. So just because a stock's price is lower doesn't necessarily mean it's the best deal. Now it may well be, and especially in the long term it may well be, but it could definitely have room to dip a little bit lower off this information. So guys, those are the main 10 stocks I'm going to be keeping a very close eye on for this entire week. And who knows, I may potentially open positions or increase positions in a few of these companies. If you've watched this far, thank you so much. Drop me a comment with your thoughts on any of these stocks or what stocks you personally are watching. I'm always interested in finding out. And anyway guys, until the next one, peace.